Thank you again for having us today for our second meeting. I appreciate your time. I know you're a busy person, and I would like to tell you that we value your time, and definitely I will be running this second meeting presentation, and hope you get some value too. Okay, just an overview first. 400 years ago, financial services started in Europe. The reason why I'm pointing always Europe is because our mother company is called Aegon, A-E-G-O-N, Aegon. They're based off Netherlands. Aegon is the biggest business mind in terms of financial services globally. In fact, we're number 4 in terms of investment, pension, and insurance. How big we are. If you know Facebook, Microsoft, and Google, if you add the 3 together, they're too small compared to Aegon. That's how huge we are. Now, of course, they came over here in 1999. They bought Transamerica and World Financial Group in cash. They put the 2 together. That's who we are, a Transamerica company. So our focus are families like yours and mine. Our mantra is, in fact, no family left behind. We are here, World Financial Group, to address some crisis here in the United States today. Number 1, savings. 80% of Americans could not save. Number 2, retirement. 94% of people turning 65 could not even retire. Number 3, protection. 59% of the adult population does not have life insurance. And number 4, living benefits. Only 2% of the population of the United States can afford living benefits. So what are living benefits? These are your chronic illness, critical illness, terminal illness, that when people cannot already take care of themselves, this living benefits would kick in. Something what you call long-term care for nursing homes, assisted facility living, and home health. Okay? And what's so fortunate about this one, we are connected with 1,500 investment companies, or 128 insurance companies, which we call our product providers. In fact, all these thousands of product providers compete for our business. Why? Because we have 60,000 licensed agents in World Financial Group. What do you mean by this? They have 60,000 chances or business every day when they deal their business with us. That's powerful, right? Now, what makes us unique is our mission. Our mission is to build and protect wealth for families like yours and mine. It's not how much you earn, it's how much you keep and make the money work for you. Now, we are non-captive. Remember this. We are not connected, or we don't represent a single company. Having said that, we give unbiased advice to our clients, or to the families that we talk to. If you are not captive, right, we don't talk about sales. We don't sell anything. We are here to educate. That's the main goal. Relationship. Since we don't represent a single company, that's powerful. Why? We don't even talk about a company, but rather we talk about the client's needs and the client's wants, and how it actually will serve the purpose in the future, where we empower clients to give them choices. Is that powerful? Perfect. But what we're going to talk to you about today is another basic financial concept, right? The last time we talked about Rule of 72, we're going to talk about that a little bit later on. But today, or for the meantime, we're going to talk about another basic financial concept called the X-curve, right? So this is your X-curve. The gray color X-curve, part of the X-curve, is what you call the law of decreasing responsibility. And the red arrow is what you call the law of building wealth. Now, on this left side, right, this is the time that you're young. When you're young where you're actually thinking of starting your life. You may probably having your own family, right? You take care of your family at a time. But, generally, on this side of the X-curve, you are less secured. Meaning you have a high responsibility and a very low money or income or wealth at a time. Of course, this is the time that you are starting to build your family. Your kids go to school, you buy a house, you buy a car, and all this stuff. These responsibilities that you will be having. It's so huge. But the rule here is, when you are younger but you're getting older, the responsibility should actually be going down. While that responsibility is going down, you should actually be knowing or doing by increasing your wealth. So that's the golden rule of an X curve. You bring down your responsibility and also increase your wealth. Now, when you get older, generally, you are more secure now because of a lesser responsibility and you were able to build wealth. That's what the X curve is for. But the thing here, the question here today is this X curve working for you or working for other families too? But what I know, a lot of families, even though they are older already, the responsibility is still big and they will not be able to build wealth. Let's explain a couple of this stuff, okay? So that's what you call X curve. Now, talking about responsibility, right? Let's talk about a dime method. A dime method is a system or a method that will actually tell you what are the responsibilities that you will be having or you already have in your life. D stands for debt, I stands for income, M stands for mortgage, and E stands for education. Okay? So D, let's talk about debt. An average American family composed of husband, wife, and 2 kids. Okay? An average American family owes about $50,000. What are this $50,000? It can be the car, your credit card, it can be your Best Buy, Kohl's, or even Target. That's what you actually owe, an average of $50,000 in an average American family. I stands for income. An average income American breadwinner is about $50,000 a year. Usually, that responsibility, we bump it to at least times 10 of your annual salary. So what do you mean by this? You have to be responsible to about $500,000. Why do you need times 10? The reason why you need to have times 10 of your annual salary as your income is anything happens to the main income breadwinner, you allow the whole family to recuperate for the next 10 years. That's why you have to have that $500,000 as your income or your savings, okay? Now, mortgage. An average American family owes about $250,000 in their mortgage. And lastly, letter E stands for education. Average American families get about 2 kids. College is about $25,000 per year. Times 2 kids, that's about $50,000. And 4-year college, that's about $200,000. So in total, there's about $1 million of responsibility that an average American family is actually facing. That's what you are supposed to protect. Okay, now, that's your responsibility, a part of the X curve. The other one is the law of building wealth. Now, the wealth formula is very easy. You have to have money, you have to have the time, you have to have your interest rate of your rate of return. But then you have to also consider inflation and also taxes. So let's talk about money. You may have a lot of money, but you don't have time and you don't have a good interest rate. Or you may have a lot of time, but you don't have money and you don't have good rate of return. Or you may have good rate of return, but you don't have money and you don't have time. So all these 3 together should actually be part of building wealth. Now, you also have to understand inflation. Average inflation rate here in the United States is about 4%. So what do you mean by this? Inflation, I'll give an example. If you have $1,000, you put it under your mattress. After a year, you take it out. It's still $1,000, but the value of that is already $960. What do you mean by that? You took 4% out of the value. You may have $1,000, but the value really of that $1,000 or the power of buying or the buying capacity of that $1,000 is only $960. Now, taxes. Now, we all know that taxes goes up every year. By the time you reach your retirement, how much do you think will the taxes be? Nobody knows. We don't have the crystal ball. Exactly. But then again, we have to prepare ourselves. When building wealth, we consider inflation and taxes as part of it. It's not about the money that you have currently in your bank. It's the value that's going to go in the near future or in the future. That's the law of building wealth. Okay? So now, let's talk about life insurance first. What kind of life insurance is right for you? Let's talk about one life insurance. There are 2 types, by the way. One type of a life insurance is called term. Term insurance, meaning it terminates at any time. Okay? Term insurance is temporary coverage, right? It actually is an affordable premium, right? And it actually does not generate cash value. Now, term insurance is affordable. Why? Because 99.4%, according to the best mathematician in the world, they call themselves actuarials. According to actuarials, 99.4%, you're not going to use it or you're not going to claim it. You will outlive your term. That's the reason why it is affordable. So that's what term is all about. Now, let's talk about the other type of life insurance. It's called permanent. Your coverage is until the person's death. The coverage, it actually generates cash value. And there are two types of permanent insurance. One is the one that is a whole life, and of course the other one is a universal life. Now, what we know, whether it's term or permanent, what we know of life insurance is you pay, you die, we pay. But it's no longer the case. How I always tell clients, it's life insurance today is no longer our grandmother's life insurance. Why? Life insurance now is upgraded so huge that you can do a lot of stuff inside an insurance. One good example of an upgrade are the living benefits. What are the living benefits? If a person is chronically ill, if a person is terminally ill, or a person is critically ill, you can already access your death benefit by those reasons. Meaning you don't have to die to use a life insurance policy. We're not talking about a cash value. We're talking about the death benefit. You can have access already if a client is already terminally ill, chronically ill, or even critically ill. That's what it's actually is all about. You can use life insurance now to fund an education fund, or you can use this for final expenses. You can use this to supplement your retirement, and etc. That's what life insurance is for today. That's powerful, isn't it? Awesome. Let's talk about, again, let's just go back about Rule of 72. Why Rule of 72 has a very big role in growing your money. Okay? So growing your money is one of this that you need to know is Rule of 72. We actually talked about this in the first meeting where Rule of 72 that Einstein said, whatever interest rate, you divide 72 by whatever interest rate you will have, that will give you the number of years your money to double. In this case, if you have 4% given by the bank, you divide 72 by 4%, that will give you 18. So money now doubles every 18 years. A person who's 29 years old plus 18, that's 47, plus 18, that's 65. So if you're 29 years old today and you have got $10,000 after 18 years, it doubles to 20. And after 18 years, it doubles to $40,000. That's what it meant by Rule of 72 if you have 4% interest rate. Let's go back to let's go to another higher number here with 12%. You divide 72 by 12, that will give you 6. So money doubles every 6 years. So instead of 18 years, now money doubles every 6 years because you got a 12% interest rate. A person who is 29 years old now doubles every 6 years. 35, 41, 47, up until turn 65. Now if you're 29 years old with the same $10,000, look at the difference. Here at the turn 65, you got $40,000, but here you have $640,000. So there's a huge difference of what? $600,000. So if I ask you, where would you want to put your money? Here, here, or here? Definitely, because this is higher in return. But you may probably agree with me, if I divide 12% by 4, that will give you 3. That's the reason why if you multiply 3 by 40,000, it equals to $120,000. But look at this. I did the math, but why is it this is $640,000? That's the power of Rule of 72, where there's growth over growth over growth exponentially. Awesome? Now, let's talk about taxation today. These are just some basic tax strategies, how your money is being taxed. So we divided in 3 categories: tax now, tax later, and tax never. Let's talk about tax now. Tax now, these are all your banking products. It may be savings accounts or certificate of deposits or your money market. You can also include stocks and mutual funds. What do you mean by this? Every year, this product, you contribute and it also grows at the same time. So if it grows, you're taxed. If it grows, you're taxed. If it grows, you're taxed. That's what it meant by tax now. You're being taxed on your income or capital gains the next year. That's the reason why you receive 1099 INT. Now let's talk about tax later. Tax later are your retirement plans. A good example of that is your 401k, IRA, 403b, TSP, annuity, SEP, and the likes. This may have different names, but it is what? The same approach on your taxes. So what do you mean by this? Every month, every year, you contribute money, but you're not being taxed. You are only going to be taxed later on. What is later on? IRS allows you to pull out your money in your retirement plan at the age of 59 and a half. So at the age of 59 and a half, you can take money out, or it's what you call distribution. When you take money out after 59 and a half, whatever amount of money you pull out, it will be taxed. But then again, if you take it out earlier than 59 and a half, you will be penalized and you will also be taxed. That's a rule, 59 and a half. But when you age 70 and a half on your retirement plan, right, Uncle Sam will force you to take your money out. What do you mean by this? When you're 70 and a half, Uncle Sam will want to get his fair share of the retirement plan that you actually have. So he forces you to take it out, but he's not going to take you out everything or all of the money, but at least you comply with the one that we call RMD, or the required minimum distribution. If you have $100,000 when you turn 70 and a half, say for example, Uncle Sam tells you, hey, you take out 4% out of that, so you take $4,000 out, that $4,000 will be what? Tax. Say for example, because you have a little, have aged a little already, and you forgot to take the RMD, or the required minimum distribution, Uncle Sam will actually penalize you 50% of your RMD. So that's what tax later is all about. Now, let's talk about tax never. Tax never is just like a concept of a farmer. Where would you want to be taxed? In the seed or in the fruit? You would rather be taxed in the seed because it's still small rather than the fruit. So that's exactly what the tax never is. Now, the source of the funds to put in on a portfolio or platform for a tax never is already a tax money. A good example of that is your salary. That salary is already taxed, so you can actually put it on a tax never platform, such as a 529 plan, which is an educational plan. But educational 529s are only for education, meaning money that you have actually incurred or accumulated for X number of years should only be dedicated to education. Otherwise, you're going to be penalized. Number two is Roth IRA. So your salary, you can actually fund it to a Roth IRA. Roth IRA is a tax-free platform that the money that you put in the beginning is already tax-free. So when it grows, it's already tax-free. But you can only take or use the money starting 59 and a half. Or the other one that we're looking for is the cash value in any life insurance. Now let's talk about options for your money. There are three options for your money, meaning where you can put your money and will get interest rate or interest or growth into your money. One is fixed, two is variable, and three is index. Let's talk about fixed. Usually the company or platform that will give you 2, 3, or 4%, that's actually fixed rate, meaning if the market goes up, you get the full benefit of 2, 3, or 4%. If the market goes down, you still get the full benefit of 2, 3, or 4%. So in essence, you don't lose or you don't gain as much. You're only as good as the fixed interest rate that they will give you. The second is called variable. Variable, you can actually get the full benefit of the market if it goes up, and also the full benefit if the market crashes. So you may win $1 million today and lose $1 million tomorrow. That's what a variable means, meaning it's erratic. It changes from time to time. So you can win or you can lose at the same time, right? Now let's talk about index. How index works, if the market goes up, you are locked onto that. Even if the market goes down, you will never get the losses of the market, but yet you only get where it's been locked at. If the market goes up again, you're locked at that one. So if the market goes down, you never go down. It's just locked to where you are. If the market goes up again, you're locked. Even if the market goes down, you're locked to where you were at. So meaning on index, you don't lose a single cent of the money that you have. There's no way to go but up. So if I ask you, which options for your money would you like to have? This, or this? Awesome. So let's talk about the 4 financial cornerstone. There's 4 financial cornerstone. 1, protection. 2, growth. 3, safety. And 4, tax advantages. These are the things that you would like to consider in any investment platform that you have. 1, does it protect you? Do you have a platform that will protect you that in any case that will happen to you, such as not able to work, or you're not able to perform duties, or not able to take care of yourself, or say in the event of dying, is your family protected? Are your assets protected? That's what it talks about. Number 2, growth. Whatever platform that you will be having, is it actually growing, or does it have the capacity of growing? We talked about rule of 72, about compounding interest, about your money options. Is it growing? Number 3, is it a safe platform? Meaning, is that able to lose money, or how fast? Sometimes you ask, is it able to lose money, or do you have a platform that will not allow you to lose money? And lastly, tax advantages. Is it a tax-free platform? These are the 4 financial cornerstones that you will need to ask in any investment platform you or your client has.